Hey everyone, today we'll be going over what a convertible bond is, all under 5 minutes, and without any further hesitation, let's get started. A convertible bond is a type of bond where an agreement between a business and the investor agree to have a type of bond which can either be treated as a standard bond or be converted into equity. The components in order to create said convertible bond are the following. 1. Needs a principal face value, where the amount of a single bond will cost, the coupon rate, indicated as the interest rate, maturity date, conversion ratio, conversion price, conversion period, call provision, put provision, yield to maturity / yield to call. And say, for example, we have a company issuing a convertible bond and they are looking to raise $2.5 billion with the predetermined plan to allocate resources and infrastructure with stable recurring revenue prior to going public on a stock exchange and issuing their shares to the public. During seed and Series A round of financing, let's say that the company issues a single bond worth $1,000 at face value. The convertible bond is indicated in this set structure. The total offering for capital that the business is looking for is $2.5 billion. Face value per bond is going to be $1,000, and the number of bonds issued would typically be about 2.5 million, and their coupon rate, which would be paid annually or can be paid quarterly, would indicate an attractive rate to entice investors before conversion. The convertible bond has a maturity period of 7 years until it can actually be converted into equity or be paid out fully in its face value. And the conversion ratio, which indicates how much of equity can the bond be converted into, would indicate as 40 shares per bond. And the conversion price would be when the share hits a price of $25 fixed. Then there's a conversion window, which starts after year 3 to allow bondholders to convert once company nears IPO in an initial public offering. And then there's a call provision, which is callable at $1,150 per bond, where we have a 15% premium over the face value after year 5. And the put provision would indicate for the bondholders' ability to sell back their bond at face value, indicated as $1,000 after year 4 if the company delays its IPO. Meanwhile, the calculated percentages for yield to maturity are respectively 7.98% and yield to call will be 8.52%. Now, we first need to ask ourselves, how are convertible bonds actually determined? Well, it's mostly related to the company's finances, where specifically companies with strong credit ratings can offer lower coupon rates because investors see them as lower risk. And if a company has higher debt or weak financials, it may need to offer a higher coupon rate or provide better conversion terms to attract investors. Now, if we were to go over the legal framework for convertible bonds, we will have to understand really over what context it will be set in place, since convertible bonds can also be sold in both primary and public offerings as well. So in the context between primary regulation, where convertible bonds by nature are governed primarily by contract law, not SEC regulations, which makes them attractive for businesses to be able to issue said bonds. And the indentured agreement defines a bond's key terms between two parties, between the investor and the business, where the conversion ratio and price is already set, along with the coupon payments, maturity date, call and put provisions, and an anti-dilution clause, since there will have to be some collateral to structure the bond. And meanwhile, if a company were to issue convertible bonds and notes in a public setting, they would have to implement and abide by the SEC regulations, where if issued publicly, companies may need to disclose bond terms in their S1 or 10K filings for public companies, or quarterly and annually reports if during a traded agreement. And if the bonds are issued privately, institutional investors under Rule 144A, the SEC regulations do not apply. And for convertible bonds in the legal framework, there is investor protections, which are based on the bond agreement since they abide by contract law in its first primary setting. There is the anti-dilution protections, which prevents stock dilution from additional share issuance, and default and bankruptcy protections, which convertible bondholders are creditors before equity holders, and conversion mechanisms, which would be dictating whether conversion is optional, mandatory, or contingent. And in the context of market regulations, convertible bonds may be listed on bond markets such as the New York Stock Exchange or NASDAQ if structured for public trading, and trading is subject based on exchange rules but not SEC oversight like equities. And convertible bonds are beneficial because for investors, there's downside protection with steady income, there's liquidity and exit options, there's lower risk than stocks and higher potential than bonds, there's an inflation hedge and better recovery in market downturns, convertible bond appreciation, and equity upside potentials. And for businesses, they also present a lower interest cost and attract a broader range of investors, flexibility with market conditions, encourage long-term investments, and potential debt reduction. Overall, making convertible bonds an equitable and smart investment strategy. Hey everyone, thank you very much for taking time to watch this. If you found this video helpful, be sure to feel free to please like and subscribe. And if you have any other questions, please put them in the comment section. And as always, take care. Cheers. Bye-bye.